Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. On today's show, the wearables tech company Oura Ring prepares to go public. We have the latest on what they're planning to raise and what the IPO might happen. HGTV and Food Network could be for sale as Paramount considers a range of options to settle lawsuits against its planned takeover of Warner Brothers Discovery. And we're going to speak with the CEO and co-founder of Unrivaled, the 3-on-3 women's basketball league, with all-star backers just completing a new funding round. But first, we start with our top story and the big deal of the day, of the week, of the year, what have you. The Wall Street Journal reporting that Anthropic is likely to tell investors that it sees a very large addressable market. We're talking tens of $1 trillion, a little bit of funkiness how they're coming to those numbers. But the important thing, as we're going to discuss with Bloomberg's Ryan Gould, is the fact that they are IPOing soon. So, I mean, the numbers aside, because I guess there's some questions about how we get to $30 trillion. I mean, it's happening, right? It's the end of the month, and you're in the team's reporting suggests that it would happen by the end of this month.
Yeah, it seems like the moment we've all been talking about for the best part of 6 months, if not a year or years, is about to be upon us. There is a suggestion that we could see an S1 flip public as soon as in the coming days, perhaps in the next week or so, that would put us on track for an Anthropic IPO potentially in the middle of September. Now, I feel like, just to clarify those numbers there that the Wall Street Journal is sort of putting out there, I think that's crucially not revenue. That's kind of targeted addressable market. That's kind of how we think about the opportunity as far as Anthropic could think about generating that revenue. And I think, just to put that in perspective, SpaceX sort of had trillion, not billion, dollars of TAM when they were going public. Anthropic is suggesting that that could approach close to $30 trillion.
And they're not even going to Mars.
Exactly. I mean, I think that they would sort of argue that perhaps that's how you would think about, all of the AI tasks that we would need to do our jobs everywhere with everyone around the world. Kind of crazy numbers, but there you have it.
I mean, same thing with SpaceX, crazy numbers, but will the market buy it? Like, what has the reception been like so far on the roadshow?
I think, this is still early days because there are bankers and lawyers and people who sort of do far more important things than I in rooms right now thinking about building shadow books. I mean, the IPO process in and of itself is, kind of opaque. There are going to be people who are left disappointed without shares once this IPO is all said and done. I think, just putting it in context, we've not seen an IPO of this size. There is Bloomberg reporting as of last week that says that SpaceX's IPO that raised around $75 billion. Anthropic is looking to go bigger. They could be approaching sort of in the region of $100 billion in a raise, which we've never seen anything like that. So it's curious to see how the market processes it.
It's remarkable that they've reached that size and so close after SpaceX too. Ryan, thank you so much. Your reporting has been excellent. Ryan Gould there with the latest on Anthropic. We're going to stay in the world of IPO. An IPO that feels just so minuscule compared to that, but still an interesting one nonetheless, is smart ring maker Oura Health is set to go public in the coming months. Bloomberg's Scarlet Fu has the latest. Hey, Scarlet.
Hey, Danny. Yeah, the numbers are a little closer to earth this time. Bloomberg learning that Oura is looking to raise as much as $3 billion in its U.S. listing. And according to people familiar with the matter, Oura could make its debut as soon as September, valued at more than $16 billion. That's compared with its $11 billion valuation reached last September during its Series E funding round. Now, existing investors are expected to sell a significant amount of stock in this offering as well. Oura would join a wave of European companies choosing to bypass their home exchanges in favor of raising money via U.S. IPOs. Oura has already re-domiciled from Finland to the U.S. and filed confidentially for an IPO back in May. So that means we don't have the latest financials, but we do know that Oura sold 5.5 million rings through September of 2025. That is up from 2.5 million sold through June of 2024. And Oura anticipates revenue to reach $1.5 billion this year. That's compared with $1 billion in 2025 and about $500 million in 2024. Danny, Oura is working with Goldman Sachs, Morgan Stanley, JP Morgan, Allen & Co., and Jeffries on this listing.
Certainly, IPOs are back. Scarlett, thank you very much. Let's get to some other big deals we are watching. California Attorney General Rob Bonta canceled a meeting to discuss a possible settlement with Paramount Skydance on Monday. He spoke with Bloomberg about the talks.
Yeah, I pulled down the meeting today because, in my view, Paramount was being too cute. They were playing games. They were disclosing through leaks to the press information that's supposed to be confidential and lying about it. They were leaking lies to the press. And in order to have productive and legally compliant settlement negotiations, they need to be confidential. There needs to be some trust in the room.
At the same time, Paramount Skydance has acknowledged that it's considering a wide range of options to settle lawsuits challenging its $110 billion acquisition of Warner Brothers, including structural changes to the deal. On all of that, Hannah Miller joins us now. Hannah, let's start with the interpersonal drama of the California AG canceling this meeting. Is that a blow? Was that necessary for Paramount Skydance to get this over the line?
I think it shows the tension that's between these two parties and that these negotiations are going to carry on. We do not know when the next meeting is scheduled. Yeah, I mean, there have been some ugly accusations here.
Yeah, it's not great for him to come out and say, we don't like what you're leaking to the media and all of that. But at the same time, it's clear that Paramount is being forwarded. Here's some remediation steps we could take to satisfy your concerns. Things like spinning off HGTV, would that be enough to address some of these concerns?
Yeah, so we reported earlier this week that HGTV and the Food Network, that Paramount would maybe considering selling those Warner Brothers assets and that they've gone back and forth on it. So yeah, that could be on the table. And we know that, there are potential bidders sort of eyeing these assets. Paramount could also maybe sell off Comedy Central and New Line Cinema, which is part of Warner Brothers. That could also be a valuable asset.
Is there movement forward, at least? I know this deal was canceled and they're doing these things, but does it seem like this, Hannah's just going to keep dragging out?
It does, and that could get very expensive for Paramount because it has to pay that quarterly ticking fee if the deal doesn't close by the end of September. So yeah, it could be a big price tag for them.
All right, this isn't going anywhere. Hannah, thank you very much for joining us. That's Bloomberg's Hannah Miller. Now, in other deal news, Vanguard has agreed to buy the digital wealth platform Altruist, marking another step into expanding its efforts in wealth management. This morning, I spoke with the CEOs of both Vanguard and Altruist.
Altruist is a business that's designed to help independent financial advisors. We're incredibly focused on empowering those advisors to make advice better, more affordable, accessible to everybody.
Today, only 1 in 5 Americans have access to a fee-based financial advisor. We would like to see that number be most Americans.
For more on this, Bloomberg reporter Lukia Giftapallu joins us. Lukia, look, you know Vanguard intimately well, and this feels odd for them. The fact that they would grow via M&A and not organically.
It's definitely not a Vanguard thing to do. They've done some small deals here and there, but this is like very targeted. They want to grow in advice. They've been trying to grow in advice under Salim Ramji. They've structured a separate unit for wealth. And this kind of feels like they're doing it to grow inorganically. It's not a deal that will help with the tech. It's a deal to help them reach more of the advice market.
Right, because they talk about, this is, an AI-powered RIA, and it caused a sell-off in February when they announced tax strategies. So for Vanguard, it's not necessarily about that tech, you're saying, the reason they're doing this.
I kind of feel that potentially the wealth side has not been growing as fast as maybe they want, or they can reach a lot more people faster that way. So it does make sense if you consider their plans. However, it does remain a pretty very Vanguard thing.
Elsewhere in asset management, we have another deal that I believe is probably the two most patriotic names of asset managers. Victory Capital buying First Eagle. I can't think of anything more that's like rah, rah, America. This one's interesting, Lukia, because Victory Capital has been in the market shopping around before this deal, haven't they?
It has, and it entered a dramatic bidding war for Janus Henderson, where it lost to Nelson Peltz and had to pull out in the end. I was a bit surprised to see the headline this morning because First Eagle bought Diamond Hill, another small boutique asset manager, back in April. It's Genstar back, so I guess Genstar found an exit, but it's not it's not two names I expected to sit next to each other this morning. So, well, it seems like Victory found its target to buy it in the end.
Imagine how good Victory, First Eagle Victory would sound.
It sounds pretty amazing, I have to admit.
Although they'll probably just keep the Victory label. Anyway, Lukia, excellent reporting. So great to have you on. That's Bloomberg's Lukia Giftapallu. Coming up, we're talking AI investments ahead of NVIDIA earnings. Jason Greenberg is the global head of IB strategy at Jeffries, and he joins us next. This is Bloomberg Deals. NVIDIA is set to report earnings after the market close in New York today. The company's influence is now a very large part of nearly every aspect of deal-making in the sector. Our next guest is focused in on tech and says companies like NVIDIA are increasingly taking up more roles in the ecosystem. Jason Greenberg is the global head of IB strategy and executive chairman of TMT Investment Banking at Jeffries, and he advises the firm's largest tech clients spanning semis, cybersecurity, enterprise software, and ad tech. And Jason joins us now to take a look at the big picture. Jason, thank you so much for joining us.
Thank you for having me.
And look, it's going to be one of the big questions on NVIDIA's earnings call is the amount of money that they're throwing into the ecosystem. The way you look at it, how is the value sort of divided of deals being formed that are actually driving true value, or because players like NVIDIA are keeping the cost of capital low and outright funding some of what's happening?
That's a great question. Look, NVIDIA at the end of the day is a supplier to and also an investor in and a financier of a lot of companies in their ecosystem. At some point, you can worry that, in fact, they're actually priming the pump on demand, and in fact, it's not real demand. Therefore, are they overstating their results, their revenue growth, et cetera? But you can also look at it from a strategy standpoint and recognize that the four largest hyperscalers out there are also developing their own technology, their own chips. And at the end of the day, the last thing you'd want if you're NVIDIA is a customer concentration issue among Amazon, among Google, among who are developing competitive products. So the real question at the end of the day is, will they actually create a competitive ecosystem that can supply itself and support itself? At the moment, the growth is so fast that none of the companies that they're actually backstopping have the capital to do it.
What about it in terms of the deal ecosystem? How much of it is concentrated on these mega deals that are being driven by hyperscalers, by NVIDIA?
Within technology right now, it used to be that software was 50% of the deal environment. Software is way down over the last year, which we can get to in a minute. But if you look at the deals that are filling the spot for them, it is AI-enabled or agentic AI businesses. Starting, if you go back to the first deals in 24 and 25, they were effectively the foundation labs and the hyperscalers leaning into acqui-hires to take talent that they, if you think of it, at the end of the day, there's hundreds to maybe 1,000 or 2,000 individuals who have the type of expertise you need to develop the software. You saw folks like Google or Microsoft or Anthropic paying hundreds of millions, if not billions of dollars to hire these people. Over the last 12 months, it's changed into filling gaps. If you see the businesses that have been bought, Cursor for $60 billion by SpaceX, which effectively filled a gap in having a coding tool for a foundation model for XAI, to more recently, you've seen rumors of companies like Descartes, rumored to sell to one of Anthropic, SpaceX, or the like, who effectively is developing much faster ability to use GPU compute capacity. It's deals like that that are effectively enabling either the foundation model companies or the hyperscalers to grow faster. What you aren't seeing yet, which to me is the real opportunity, is when do you see the agentic enterprise software businesses? Think a Harvey, think a Sierra, you can extrapolate those. When do those actually get acquired, if at all? And is there actually a buyer universe for these? You could argue that, Anthropic, OpenAI, and you've talked a lot about the IPO environment. In many respects, is that the reason these companies beyond liquidity need to be public, so they have an acquisition currency to go build a model?
So when do you think that happens, that you see some of these agentic software companies start to follow that path? Is that in the near future, or is there something still holding it back?
Well, one, I think they need an acquisition currency. You are seeing something which I don't think you would have believed 10 years ago, which are large private companies doing billion-dollar or multi-billion-dollar deals in the private market. There's enough capital and capacity to do that. I think when you start getting to $10 billion plus deals, which certainly it would take to buy a Sierra, it would take to buy a Harvey, it would take to go down that long list, I think you do need stock as an acquisition currency. You saw that with Cursor waiting until SpaceX went public. I think you need the currency. I think those will come about. Will they get acquired really comes down to a question of, will the foundation model players, the frontier labs, actually continue to own a disproportionate share of token usage and capacity, or will that go to the open source models? Do they need to move up from offering effectively intelligence to offering applications sitting on their own intelligence and acting as a effectively captive source of demand for the models that an Anthropic or OpenAI build? I think if the answer is yes to that, you're going to see them as aggressive acquirers of the leading agentic AI enterprise application businesses.
Well, so in the meantime, the rest of the software business, to your point, as a share of deals have been getting done, have way slowed down. It's a market that feels quite frozen. Is there a degree of denial in sponsor-backed private equity for these deals about where valuations should actually stand for them? Is that part of the problem?
It's a great question. I don't know if it's denial so much as it's a recognition of I don't need to transact. I think there is a whole subset or class of software companies where the GPs, the private equity funds themselves, and their LPs effectively are enabling each other not to transact by keeping marks too high. LPs, because they don't want to recognize during their tenure as the head of whatever investment fund they have. GPs, because they haven't yet raised their next fund, where they don't want to transact. And you're seeing, just to put statistics against it, you have almost $4 trillion of AUM right now sitting in private equity. You have $1 trillion of committed but uncalled capital. Lots of money out there. If you look within software, you've got lots of companies that are, for lack of a better word, zombie companies or are stuck in purgatory where they're 18 to 22 investments that are now 5 to 7 years on into investment that ought to be transacting that aren't doing anything. And they're not doing dividend recaps. They're not really focusing on getting CVs. There's not a liquidity event coming, and yet they're stuck there. They're not growing fast enough to create a return. Base rates have gone up to such an extent that right now they're really just covering debt service. I think there has to be a window. There's absolutely willing sellers today among private equity, and there's desirous buyers. The issue is you have a financing environment for software that isn't amenable today to leaning in to do 7 turns of adjusted EBITDA in terms of leverage. You have base rates that are making the cost of first lien loans 10 or 11%, not 5 or 6%. It just means to get the deals done at a multiple where sellers aren't willing to transact. So I think it's really a pricing issue. It's not a desire issue.
And I mean, to that point, we have stories like Bloomberg reporting that Thoma Bravo having to have increased concessions when it comes to getting more debt for these companies. But Jason, what you're describing sounds like long-lasting trends. On the macro side, what we've heard from the Fed doesn't seem any desire to cut rates. So what happens then? Do we just remain stuck in purgatory for that much longer?
Well, look, the normal forcing function would be covenants on loans. The issue is you've gone from, 10 or 15% of loans in 2009 having covenants to less than 10% having covenants in 2026. So the interim forcing function that rings a bell saying this company is in distress or potentially leading to default doesn't exist. You have a lot of lenders who have recognized that they don't want to own the keys to the kingdom. A lot of direct lending funds, a lot of business development companies, they don't really want to own these businesses. So the question is, it really is, like you discussed with Thoma's recent refinancings, how do I refinance these, give a longer runway to some form of path? I think you're going to see some number of companies that are lower growth, more margin optimized, that are over-levered, simply have to hand the keys back, and you've seen a handful of these happen. You'll have a number that will effectively extend the runway, and eventually, I think the pricing they can accept, the MOIC that they're willing to take, at a much lower IRR, they'll get the deals done. It may not be in the 5 years they were hoping. It might be in 12 years, but you'll see those kinds of deals happen. And some number of them will find a way through operational improvements, through M&A to get out of it. But we're sitting with a pig in the python right now in terms of a huge number of companies that are effectively gumming up the system.
Jason, I would love to just leave it with this, because we were just talking with one of our reporters about what's happening with Paramount and the states pushing back. We had entered this administration with this idea, we're going to be in a more regulatory-friendly environment, and M&A can get done. Again, just if you were to use Paramount as an example, maybe that's not quite the truth, and I wonder how you see it, the ease at which this regulatory environment allows for M&A to occur.
So I think you have to separate the M&A environment and regulatory between the U.S. and Europe, because I think in the U.S. you have a very pro-combination environment out there in general, unless you actually have something which angers states, individuals, et cetera. I think that really depends on what happens in the midterm elections. I think that may change the tone and tenor a little bit. But in general, you have a pretty open environment right now to get deals done in the U.S. But in Europe, you're not seeing the same thing. Whether it's the UK and the CMA, whether it's the EU, you are seeing more deals held up in Europe.
This is all changing so quickly, whether it be that or just the technological environment. Jason, I mean, you're a veteran of this industry. Before Jeffries, you were at Credit Suisse for over a decade. Have you had a period in your career like this where things are just rapidly changing?
It feels a lot like the 2000-2001 life in tech in terms of the changes.
That's not comforting.
Magnified. No, I'm wildly optimistic long-term about what AI does. I think in the short term, anytime you have hyper growth, by definition, you're going to have pockets of misinvestment. I think we'll have that in this cycle as well. I think when things slow down a bit, you'll see where things were misinvested. But if we come back, and I hope to have this discussion with you in 5 or 10 years, I think you're going to see magical events happening in tech.
Well, I hope we talk again before 5 or 10 years as well. Jason, thank you so much for joining. It's been such a pleasure to have you. That's Jason Greenberg with Jeffries. Coming up, we're actually going to follow on up with what some of Jason was discussing in private equity about the cash crunch due to an exit backlog. We'll talk about some of the manager's favorite tactics to bring in liquidity in an alternative view. That's coming up next. This is Bloomberg. Time now for an alternative view. And as we were just discussing with Jason Greenberg, private equity is being squeezed for cash returns with payouts dropping substantially, causing firms to embrace a technique of financial engineering, so-called structure equity. The strategy allows managers to combine debt and stock and trades and provide immediate liquidity, but skeptics call this a costly band-aid. Let's bring in Bloomberg's Laura Benitez for more on this. So, Laura, the story you and the team, you talk about pref equity. It's something that has been around, but what exactly is it, and why is it being used more frequently?
It has been around for a long time. It's certainly nothing new, but the use case for it has become more interesting, and that part is really growing. So for all the reasons you were just discussing previously, private equity's been struggling to sell assets because of high interest rates and that mismatch in valuations and pricing. And that spurred a whole host of creative ways of trying to unlock cash to give back to existing investors who want out of funds who, where they've been there for longer than they would have expected to. And part of that is structured equity and preferred equity. And we've been digging into all the use cases, which has been to unlock value for those existing investors who have been waiting to get out of those funds. And it allows new investors to come in, usually temporary, it can be 3 to 5 years, in exchange for lots of upsides, like priority claims on future sales and warrants and things like that. So it's been an interesting subject to dig into.
Laura, I just got 30 seconds here, but are LPs for the most part okay with this? They get their cash back? That's all that matters?
For those that want it, yes. I think 2-3 years ago, there was much more backlash. I think now a lot of investors have become more pragmatic. This whole new world has become, more normalized in terms of the types of financial engineering. Having said that, there are specific situations, and there always will be, that, investors will push back on. We're certainly on the lookout for that. So I think it's a mixed bag right now, but one to watch.
Laura, thank you so much for bringing us this story. That's Bloomberg's Laura Benitez. Up next, the race for computing infrastructure. We'll cover it for you on our investment committee. This is Bloomberg. Welcome back to Bloomberg Deals. I'm Danny Berger. As companies rush to finance and build out AI data centers, they're increasingly facing resistance from both the public and some elected officials. Let's go to Scarlet, who's taking a closer look. Scar.
That's right, Danny. Texas has become ground zero for the public backlash on data centers. 9 months ago, Governor Greg Abbott called Texas the epicenter of AI development when Google announced a $40 billion investment across the state. Today, Abbott has hit the pause button on new projects. He now wants data centers to pay for their own power infrastructure, use water-efficient cooling technologies, and stay out of rural neighborhoods. A recent poll found that the majority of Texan voters oppose building a data center in their community versus 29% in favor of it. Another poll found 3/4 of Americans overall oppose a data center being built near where they live. Now, in blue states, Pennsylvania Governor Josh Shapiro this month signed an executive order requiring data center developers to meet strict requirements before projects can begin. While in Chicago, Mayor Brandon Johnson wants a moratorium on data centers and signed his own order to create new rules for future developments. So this puts them all at odds with President Trump, who remains bullish bullish on AI development. He argues data center projects create jobs and tax revenue. We're going to have more in-depth coverage on this battle over data centers next hour. Join Bloomberg journalists for an interactive live Q&A conversation at 1 p.m. Eastern Time. It's free for anyone to listen. Join Ed Ludlow and his colleagues at Bloomberg.com/live QA.
And I just point out what's most important with Scarlet said is that starts in 30 minutes, so don't turn off your TV yet and go to it. Stay with us. Scarlet, thank you so much for bringing us that story. And it sets us up perfectly for this week's investment committee, where we take you into boardroom debates in real time. Today's IC, it is Maria Goodpaster, partner at McKinsey. She's a leading voice on the future of computing infrastructure. Melissa Kalka, M&A and private equity partner at Kirkland Ellis, and she works with PE clients, advising on complex data center transactions. And Kate Dorsey, managing director at Stonepeak. She's been focusing on the energy and infrastructure side for years, specifically in debt markets. Thank you all so much for joining. Maria, let me start with you. When you're talking to clients about opportunities in data centers, where are they? What are you most frequently pitching and hearing back of where people want to be?
Yeah, there's many conversations and many opportunities.
I'm sure.
I think my conversations with clients are primarily around the supply chain and infrastructure constraints. So obviously power is the largest constraint that everyone is talking about. In addition to that, I think what people don't talk about as much is some of the other hardware, like high voltage transformers, backup generators, all of which are highly constrained as well.
It also just speaks to the complexity of this ecosystem. Melissa, how about you? What have you seen in your conversations as the sector within data centers is most ripe for opportunity?
You know, it's incredible. And, almost 15 years of practicing, I've never seen such a dynamic industry. And it's changed so much. Flashback 2022, take private of CyrusOne, that was $15 billion. Now we're looking at $40 billion deal for Aligned. Within that time, the valuations changed because of the size and scale. It also created this opportunity to invest in so many different parts of the value chain, whether that's actually, a development project, a stabilized asset, going to the GPUs, the fibers, all of the pieces you can invest in now like you never have before. So I think everybody's kind of looking for the same pockets of capital. So it's, what can we do different? Where can we protect risk? Where can we get the best returns? Because at the end of the day, you're still sourcing from the same pools of capital, and the demand for capital is just at a level we've never seen.
Well, you are one of those pools of capitals lending out money for this. Where do you find that kind of ticks off the boxes that Melissa was just talking about?
Yeah, it's interesting. So at Stonepeak, we're an infrastructure manager that's focused across the infrastructure spectrum, broadly defined, spending a lot of time in digital, obviously a lot of time in data centers. We stood up our own hyperscale data center platform last year. And so where we're seeing a lot of opportunity and really where we're focused are on opportunities that are really, we're looking at through more of an infrastructure investment lens. So making sure that the power is there, that we have the grid interconnection activity, that we have the strong contracted demand and highly creditworthy counterparties. And so I think where we're spending time and making sure that where we're directing the opportunities is places that do have the power, which I think is becoming one of the biggest constraints, but also the biggest area of value add if you can sort of solve
I was going to say, because, clearly that constraint is a problem that everybody's thinking about. But Kate, how do valuations look? Because presumably that opportunity set is small because it is a bottleneck.
I think that's exactly right. I think you're seeing, people ask if sort of are valuations fair in this market or they're, overblown. And I think it's a little bit of a mix, and it really depends on having all those components in place. And so where you do have assets and companies and platforms that are focused on those, having the power, having the interconnection, it's not as much of a speculative build. I think premiums in those spaces could be warranted. I think where you're seeing the differentiation is more for the spec builds or for, so there's definitely a differentiation between capacity on paper and real deliverable capacity.
How much of a concern is the spec build, Marie? This idea that you could have stranded assets of people who are saying, oh, I have this, a project site I'm building, but I don't yet have power and I don't yet have a lease signed.
It's a real concern. I think particularly the sites that don't have power and don't have equipment buys for those critical pieces of constrained equipment. Look, it's a market where you're going to have winners and losers despite the growth. And so those are definitely some that are considered riskier.
Yeah, I think it's spec builds are hard. And as we look at going to underwrite and helping our clients look at investments, the risk profile is the number one thing, because it's going to drive, can you get financing? Are you having to look at an equity build? Are you doing a preferred investment? What type of ultimate financing solution? I think you have to look, our clients are looking at the very beginning of the life cycle to say, what happens from pre-dev all the way to kind of what is the quality of the contract? Because right now, even projects that are under contract, if you've got 5 hyperscale contracts with the same person and one does not look like the other, financing is not going to be the same. And that's a different risk return profile for an underwrite. So I think as we look kind of what people are focused on, I'm still not seeing a ton of people involved in the spec because there's just too much focus on right now diligence up front on the power. And can you actually get there? What is the timeline? Is it going to be available? And what is the bridge solution? I think people are getting incredibly creative as it relates to the power alternatives. So considering alternatives like micronuclear, fuel cells, turbo cells, and you're looking at alternatives to bridge that gap for a grid connect eventually.
By the way, I'm assuming some of the creativeness is not just in the power, but is in the financing. And Kate, I feel like that's where you probably come in. How much of this ecosystem is not getting financing from traditional banks, but is looking to players like Stonepeak?
Sure. I think it is interesting because there has been this evolution as from the beginning of the data center development, which it's gone from a more real estate type lens to now being viewed really as an infrastructure asset where you need all of these other components in place. And I think one interesting trend is just because there has been this overbuild, you're seeing the traditional markets like the bank markets. We're hearing that there's an oversaturation. They're sort of at capacity for certain hyperscalers and certain developers. And so I think borrowers are having to get a little bit more creative about what markets they're accessing. And I think, for well-structured projects, the bank market's still very much open. There's a lot of appetite. I think we're starting to see borrowers pivot to more accessing the public markets. I think there's a really strong depth of investors in the public markets, and we're seeing the pivot there just to get breadth of capital and different pool of investors. And then I think you're also, depending on the earlier life stages of the projects, like really seeing private credit come in play as well. So I think for well-structured projects, there's really no shortage of capital, but it is really being able to show that there's appropriate risk allocation and mitigation of all of the components that we've been discussing.
I think the market's gotten creative, though, from that perspective. 12 months ago, you didn't talk about the bond market as it relates to a solution for data center construction, much less long-term financing. And within the last probably 6 months, there's been several, including like the large related transaction that was, I think, a $14 billion bond offering. So we're accessing pockets of capital we've never seen before.
I am just struck, though, like one of the common threads that you were talking about, Kate, is you can do that assuming that you are one of these like high quality sort of offerings. And Maria, how many of these offerings are high quality at the moment? Like how many are able to access all this creative financing, are able to access public bond markets? Or for most that are looking at building a project, is it a steep hill to climb?
It's definitely a steep hill to climb. If you look at how investments were a few years ago, it was largely being funded by hyperscaler balance sheets. And so now the complexity has just increased as the amount of gigawatts builds out.
By the way, we don't have a lot of time left, but I would love to just hit on what Scarlet was talking about, and that is sort of the political backlash. Maria, how big of a headache is that for getting projects done? Does it slow down some of the deal flow? The fact that you have Pennsylvania, places in New York talking about moratoriums, especially as we head into midterms?
Yeah, the community backlash is very real. And concerns that people have are higher utilities, the water usage, the noise, the emissions in their communities. And it now has to be considered part of the business case. It's now part of the investment choices that have to be made. And certainly it's shaping where the capital allocation and where the site selection is.
Do you think it slows down the pace of deal as well? Might we not see it as much as we did maybe compared to last year, for example, because of the political bottleneck?
It'll definitely slow down the pace because some investments have already been made, and now we're seeing players pivot from those and abandoning some sites in some cases.
Kate, does that happen to you that you're looking at investment and you say, whoa, let's pump the brakes on this? I'm concerned about the politics behind it.
Yeah, I think across our portfolio, we're always highly focused on regulatory and permitting, and it's a big part of sort of our diligence process. And so obviously it's a big piece of the investment making decision process. But I think, it does slow it down. I think it is more of a filter of just making sure it's the right types of projects are getting built. And that means the projects that have the access to power, the grid interconnection, the contracts, the sponsors that have the capital to make sure that they are being able to fund the infrastructure that they're using. And so I think, it's not necessarily a roadblock. It's just more of a filter to make sure that we're supporting the right types of development.
Melissa, I'd love to give you the final word on this because I'm assuming this takes up a large portion of your day and your work with clients right now.
Yeah, absolutely. It's certainly front of mind of needing to make sure that the community engagement angle works. It's hit every aspect. Lenders are focused on it. The customers are focused on it. The sponsors are focused on it. What happens if a moratorium goes into place? What happens with the customer contract? What happens with the financing? Ultimately, these are state and very local issues. And so it's something that I've seen the most successful developers have been those that have gotten into the community, gotten to know the people that are going to have this data center around them, making sure there's buy-in from them. And it's really kind of taking an approach of making sure that all the pieces fit together, but this is certainly a gating issue as it relates to transacting.
Unfortunately, that's all we have time for. Thank you all so much for joining. That was so brilliant. That's today's investment committee. Thank you to Maria Goodpaster with McKinsey, Melissa Kalka with Kirkland, and Kate Dorsey of Stonepeak. Up next, a bit of a different topic, 3-on-3 Women's Basketball League. Unrivaled, they just finished a funding round that pushed its valuation to $650 million. The CEO joins us next. This is Bloomberg Deals.
We're just about halfway through the trading day in New York. I'm Norah Mulinda. Let's take a look at your midday movers. First up, stocks falling as investors digest the latest inflation data, which came in well above the Fed's target. The benchmark 10-year Treasury yield climbing to around 4.7% as traders weigh the Fed's next move. Over in healthcare, Boston Scientific down after revealing a cybersecurity problem affecting some of its tech systems around the world. And speaking of tech, Snap heading for its worst days since June after Pennsylvania's AG sued the company. The lawsuit accuses Snap of failing to protect children from the addictive nature of its app. And Meta facing similar scrutiny, the stock gaining after the company agreed to pay up to $18 billion to settle allegations that Facebook and Instagram were designed to encourage compulsive use among young users. It removes a substantial legal risk to the company. Earlier today, the Attorney General of West Virginia spoke to Bloomberg about the settlement.
What you're seeing is that these tech companies are recognizing that their products can and are dangerous to children, and that they need to be doing more to be cognizant of that, to admit that, and that they have the tools to make it better. And we're really, really excited about what the future looks like for children in this country who use social media platforms.
Those are your midday movers. I'm Norah Mulinda.
You are watching Bloomberg Deals. I'm Danny Berger. Unrivaled is a professional 3-on-3 women's basketball league co-founded by WNBA stars Nafessa Collier and Brianna Stewart. And today, Unrivaled announced its Series C fundraise led by 10 Pillar Sports Fund. And it has surpassed an initial $100 million target and is now oversubscribed at a valuation of $650 million. The rounds include reinvestment from Carmelo Anthony, Ashton Kutcher, Alex Morgan, and Washington Wizards guard Trae Young. Unrivaled CEO and co-founder Alex Bazzell joins us now. Alex, thanks for joining. Congratulations.
Of course. Thank you for having me.
And all of this means that your valuation has nearly doubled from where you stood last fall. Where has that growth come from for Unrivaled?
Yeah, well, we went on tour for the first time. So anyone who hasn't watched us yet, we're based in Miami. We play all our home games there, but we went on tour to Philadelphia, and we actually broke the venue record there that existed since 1999 with the Backstreet Boys, and then went to Barclays in Brooklyn and sold that out. So it's a testament to, I think, our revenue growth that we've seen over the last 2 years, that's how old we are as a league, as we move into season 3 and we scale out that model a little bit more.
How much of this is also beyond just the in-person entertainment, but also TV rights and other various media rights?
Yeah, so we have a great partner in Warner Brothers Discovery and TNT Sports that we play all of our games on national television there. So We signed a great media rights deal with them. That's a 6-year deal. So it's a big driver for us from just a overall business and revenue perspective.
It's kind of funny because when you talked with our team about this fundraise, you basically said, we don't have an immediate need for this, but we would like to be more aggressive. What does aggressiveness look like in the growth of this league?
Yeah, we want to bring this to more cities. You know, we're going to expand our tour model. We're going to go to over 8 different stops this year compared to 2 last year. We'll be on both coasts. You know, we'll start the season on the road. We'll finish the season on the road. And just bringing this to more fan bases is really priority number 1. And then 2 is the investment into our current home arena. You know, we only have 1,000 seats. It's a very intimate experience for fans that come. But we want to build that out and bring more fans in and obviously elevate the experience there.
You know, in terms of where you go from now, how do you sort of pick the cities that you're going to be touring on? What does that decision look like? And any cities you want to announce for us that they can get excited about watching Unrivaled in person?
Well, we'll be back to the Northeast. I could say that much.
That narrows it down a little bit.
It narrows it down more. We look at a combination of current WNBA cities that are already supporting our players. You know, we have our entire roster is full of WNBA stars that play with us during the WNBA offseason. But it's also bringing this to new markets. You know, if you look at the WNBA compared to even the NBA, they have just about half the amount of markets that the NBA's in. So there's so much room to grow the sport here domestically and then eventually, like, obviously internationally.
How do you attract the talent with the new collective bargaining agreement from the WNBA? Presumably, you can't sort of have the thing of, oh, we're going to pay you more, considering how that has shaked out. So how do you make sure you can still get that talent if maybe pay isn't the main draw anymore?
Yeah, well, I think it's a combination. Pay is still important for us. We're up there with any other sport in terms of what's compensated, which we're proud of. But they're also equity holders in this league. And as you started with, like, the value of the business keeps growing, and they're the largest majority group that owns the upside of the league. So it's twofold financially and upside of them. And then lastly, it's you develop and own your skills. And it's an iron sharpens iron mentality during these months that they're with us and with these other star players.
Right, Alex, unfortunately, we're going to have to leave it there. I would love to talk more about this, but I know you will be appearing on the Business of Sports podcast.
Yeah.
So everyone needs to listen to that, too, to get more details. Alex, thank you so much for joining.
Thank you for having me.
That is Alex Bazzell, co-founder and CEO of Unrivaled. Speaking of basketball, coming up, we're going to be talking about LeBron loans. Yes, you heard that right. And the fallout from the sale of the Lakers. More on the latest drama on Mark Walters. This is Bloomberg Deals. You are watching Bloomberg Deals. I'm Danny Berger alongside Scarlet Fu. And just months before LeBron James joined the Lakers in 2018, a limited liability company he controls borrowed almost $300 million from a pair of Midwestern life insurers advised by an arm of Guggenheim Partners. Bloomberg's chief Wall Street correspondent Sridhar Natarajan has been reporting on that story. And Sri, obviously this is important because Mark Walters of Guggenheim has been looking at unwinding some of his balance sheet. So how do these LeBron loans factor into all of it?
Sure, it might be important from that perspective and might be the reason why we stumbled across this. But more than important, I think it's really interesting. There is no sign, just to be clear, there is no sign, no indication it has anything to do with the current inquiries. But much like us and other newsrooms that have been scouring through insurance balance sheets and trying to understand what's on there, we stumbled across this 2018 deal, which same year LeBron signed a $154 million contract to join the Lakers. We find out it wasn't even the biggest deal of the year for him. There was this $300 million deal structured as bonds to unlock upfront capital for him and backed by his future revenue stream, future earnings from everything outside of basketball. Think, for instance, the lifetime Nike sponsorship deal, which, by the way, athletes, artists are increasingly starting to do that and doing it more often. It started with David Bowie back in the 90s, but more and more people are doing it. It's a way for ultra high net worth individuals to finance themselves. It's a way for the LeBron James and the Taylor Swifts of the world to get immediate liquidity. But for us, the interesting point was it also shows how life insurance is just not this boring corner of the market anymore. Increasingly, they are moving into more unusual investments as asset managers and other Wall Street power players take control of these investments and move this capital into perhaps riskier, but definitely higher yielding investments.
Talk about creative financing. I mean, this is kind of peak creative financing. What's the latest with the TWG, the group that Mark Walters controls?
Look, we've only been talking about this for the last 2-3 weeks. It's in some ways it's been the sports story of the year. It's been the Wall Street story of the year. But a very interesting combative statement from TWG out this morning. Unusual for a company under a federal probe to come out with a statement like that. But they put out a massive statement saying there is no indication of fraud. There is no fraud. Their whole point is there is no victim here. At the heart of it, they say, is a regulatory matter. That regulatory matter is the fact that they misclassified nearly almost or more than $20 billion of investments that should have been marked as affiliated assets, were marked as unaffiliated, were only changed after they received federal subpoenas. But having said that, their point is there is no harm done here, and they will get through this without much trouble.
Hey, Sri, excellent reporting. It's been such a joy and an interest to follow along on what the work you and the team has done. That's Sridhar Natarajan. And as always, Scarlet Food will just take you out on this bit of breaking news. As we wait the Anthropic IPO, they will be leasing N-scale data centers for $45 billion, and they're going to get 460 megawatts of power from that. Again, we'll bring you any Anthropic news as it crosses ahead of their IPO. And that does it for Bloomberg Deals.